Let me now bring on board Nilesh Shah, Managing Director and Chief Executive Officer of Axis Direct, who joins us live. Nilesh, good morning and thank you for joining us. Nilesh, for someone who's trading long, I guess the big question is that of late Indian markets have managed to climb the wall of worry. But in the short term, is this as good as it gets?
I think yes. The markets have been remaining firm, and especially when we met last on vote on account, markets were a little bit down, but from there it has recovered. So my feeling is that as we move into the next phase of uncertainty, the GDP growth was lower, quarterly results of March will influence the market, and then the biggest question will be election results. So markets will be volatile, and probably in the near term they will consolidate around current levels, neither big up move nor big down move.
Nilesh, we've seen, if I look at the liquidity situation, flows of late have been much better. Emerging market currencies have stabilized. Foreign institutional investors are once again redeploying money in Indian equities, and domestic institutional investors are selling less and they are buying more. So do you think tapering concerns and liquidity concerns for the moment have taken a backseat?
I think more than the tapering concern, I think the foreign institutional investors have started picking probably stocks on a bottom-up basis rather than just looking at the overall macro. The last week flows has been almost 80-85% of this month's flows or this calendar year's flow. So clearly we have started seeing FIIs coming back into the market more on a bottom-up basis rather than worrying about the macros. Their understanding of Indian political scene as well as Indian economical scene is as good as the local investors. The other interesting part is that in the month of December, Jan and Feb, we have seen fairly robust flows from the debt investors. They together have pumped in almost 30,000 crore into Indian debt market. So clearly debt FII flows have been fairly strong, and that in turn would have supported rupee apart from many other things, and that is giving confidence to FIIs to pick up stocks on a bottom-up basis.
Nilesh, what about the economic health? Because we've seen the GDP numbers come out, and while the overall number is in line, it's only services which have shown you a jump. Manufacturing as well as construction have been a dampener, as well as agri has come down from the last few quarters.
So clearly, if we dissect the entire GDP growth for third quarter, which came at 4.7%, little below 4.8% general expectation, it's primarily driven by two factors. One, overall manufacturing has degrown, and within manufacturing it's driven by mining sector where growth has been negative, and the construction sector where growth has slowed down dramatically. Clearly these are the two Achilles heels for the Indian economy. The environmental concerns on mining sector has created its impact, and the construction sector has slowed down, which typically happens before the election. So if we can manage these two sectors, then certainly growth can be revived. If you look at from the expenditure side, the investment has been running at a lower and lower growth rates. It has not yet become negative, but it's just marginally positive. So in some sense, revival of investments, revival of mining and construction sector will be imperative for economic growth to recover.
Let's talk about the two crowded trades, long IT, short bank. Do you think both these crowded trades now will get challenged?
No, I don't think so. In the IT sector, the valuations are just around the median valuation of last 5 years. So valuation point of view, IT doesn't look that expensive. Second, with the currency movement and the likely scenario of uncertainty in the market going forward, there will be trending towards the safe sector or defensive sector. So that will also keep on supporting the IT. Third, globally we have seen that the e-com related transactions have taken place both in the secondary market in terms of acquisition as well as primary market in terms of IPOs. Certainly right now in the US market we are seeing increasing IPOs from Chinese internet and Chinese e-com companies. A balancing part of that will be probably Indian IT sector also. So whichever way we look, neither IT sector looks expensive, nor it's the defensive nature of IT sector will allow investors to move away from it. So from that point of view, long IT sector looks a particularly good trade. On the other side, in the banking sector, especially the public sector undertaking, the valuations have become quite compelling. However, in the near term, there are no triggers in terms of, their concerns on the NPA side. Clearly, they will be beneficiary if there is a strong government and adequate steps are taken to address the concerns on the NPA side. So for the time being, long IT, short PSU bank trade appears to be good trade.
Within banks though, Nilesh, would the cheaper value private sector names be your preferred call?
Definitely. We have been maintaining that trade for a while. And we think right now there is a fair amount of polarization between cheaply valued or attractively valued private sector banks vis-a-vis expensively valued private sector banks. The market is placing very high burden of expectation. Some of the highly valued private sector banks will have to create a couple of public sector banks in 1 year, what public sector banks have created over centuries. So clearly, the markets will shift towards the attractively valued private sector banks within the overall financial services space.
Okay. Nilesh, how would you approach the auto space? Because each of them are working on fundamentals and dynamics of their own, but the one underlying trend seems to be that there definitely is a demand slowdown, an excise duty cut being passed on to retailers or not. That doesn't seem to be working, at least in the near term.
I think within auto sector we'll have to now divide all the three components separately. The two-wheeler companies are running on their own dynamics, which is primarily urban consumption. The commercial vehicle is driven down by the slowdown in the mining and the construction sector, and the four-wheelers where primarily corporate activity is influencing the decision. So overall in the auto sector we probably foresee that in the near term there are no upside triggers. You have concerns in terms of tight liquidity and higher interest rates. You have concerns in terms of inflation curbing urban consumption. So effectively the demand will be slowed. In the excise cuts, even though it's being gradually passed on to the consumers over a period of time, is unlikely to have a material impact onto the demand side. So in this scenario today, probably you will have to be very, very select bottom-up stock picker in the auto sector rather than overall top-down approach.
Nilesh, do you think the price action in IT is going to shift from large cap to mid cap? Because of late names like Tata, LXC, or for that matter Geometric or Hexaware, they managed to outperform markets?
From a trade point of view, potentially yes. However, from an investment point of view, I don't think so substantial allocations will be met towards mid-cap IT companies compared to large-cap IT companies. All the large-cap IT companies are delivering fantastic growth, and the valuations are not very expensive. So bulk of the allocations will continue to occur towards large-cap IT stocks, and maybe 10, 15, 20% of portfolio will be allocated towards mid-cap IT stocks. Within mid-cap IT stocks, one will have to be very cautious in picking up, because we have seen over a last almost 10-year cycle that all these companies are more cyclical in nature rather than structurally uptrending story.
Nilesh, do you think the turning point has come for an average Indian retail investor? Because suddenly domestic institutional investors are selling less, they are buying more. The fact that price action has started in mid and small cap stocks and non-institutional dominated stocks, does that mark the return of HNI / retail investor?
I think yes. We are seeing an overall big shift in the allocation of savings from physical assets to financial assets. Gold has given negative return, and even with massive currency depreciation over last 1-2 years, it's underperforming other forms of investments. The real estate also is at DC heights, and clearly in most parts of the country it looks expensive and it's unlikely to give as much return as it has given over last 5 or 7 years. The allocation now has to shift towards the financial assets, and within that bank deposits will just give about inflation return. Your returns will be made in equities, and we have started seeing increased retail participation in the equity markets. We saw the Power Grid FPO, where almost 400,000 retail investors participated. We have seen a couple of mutual fund NFOs where retail investor participation has been fairly good. And we are seeing at Access Direct fair amount of participation by retail investors. So clearly this is a big broad trend shifting from physical assets to financial assets, and within that I believe allocations will be more towards equities. However, that allocation is unlikely to be a very smooth affair where every month on month it will keep on increasing. It will be volatile depending upon how the markets move, but overall we will see from here onwards increased allocation to financial assets, especially equities in the retail investors' portfolio.
Big block deal in Asian Paints on the BSE. Almost about 18.5 lakh shares have traded hands. Nilesh, the one sector which has really stood out of late for the last 2 weeks at least has been capital goods. Is it a typical pre-election trade playing out, or do you think these stocks are now genuinely looking attractive for a buy?
So within capital goods, I think we'll have to divide the sector among various parts. On one side, you have multinational capital goods company. These stocks are supported partly, one, because some of those companies parents have increased their stake or made delisting offers. Clearly, valuation there is getting supported by that activity. There are certain multinational engineering companies where they are introducing latest products and latest technology, and they are grabbing market share from Indian players. Certainly, these counters are supported by the growth. So overall, multinational engineering companies, either because of the launch of new technologies, new products, or because of the parent support, looks attractive from investment point of view. On the other hand, we have many small and mid-cap engineering companies which are sitting on large amount of assets, but their valuation is completely out of sync with what their inherent value is. Now, these companies today are going through a cycle which is probably at the bottom and about to take off. This portfolio of small and mid-cap engineering companies sitting on large amount of assets but available at a huge discount to their fair value provides very, very attractive investment opportunity, albeit in the short term there is no trigger, unlike in the MNC engineering companies. And on the third hand, we have some of the Indian engineering companies which till today were enjoying protection because their competition was not very hard. Competition was not introducing latest products and technology. These companies are probably in perennial decline. They have high wage bill, they have inferior technology, and it's unlikely that they will be able to recover from current level. So within engineering space, you'll have to be either in the multinational engineering companies or into small and mid-cap Indian engineering companies which are available at a significant discount to their fair value.
Nilesh, even though Indian markets have managed to reverse whatever they've lost in the first 6-7 weeks of trade this year, if I look at the underlying trend, IT is right up there, metals and PSU banks are right at the bottom. So in terms of a market setting, in terms of a market positioning, the positioning is still exporters and quality.
I think you'll have to divide your portfolio 80% towards quality and defensive sectors, where pharmaceutical, technology, media, private sector banks and finance companies probably will occupy bulk of the portfolio. But about 20% of your portfolio could be divided towards those stocks which are available at a significant discount to their fair value. I talked about Indian engineering companies in small and mid-cap space. They're sitting on tons of real estate, tons of hard assets, but their valuations are available at a huge discount to their fair value. Even the mid-cap cement companies provide a very attractive opportunity. They are all today available between $25 to $55 EV per ton. The cement cycle is nearly at bottom. The capacity utilizations have declined from upwards of 85% to just around 70%. Over next 2-3 years, as the economy recovers, cement capacity utilization will go up. Newer cement capacity is unlikely to come up at a frenetic pace as it has come up in last 5-6 years. And this mid-cap cement companies when cement industry recovers, will probably give bumper return from current level. So you could allocate 20-30% of your portfolio towards this kind of value bias stocks, where stocks are available at a significant discount to their fair value. You'll have to build a portfolio because you never know which one will move first. But if you do a value-based portfolio approach, I think it will work very well over next couple of years.
Nilesh, it's been a big comfort factor that the rupee has stabilized overall. What's the sense that you're getting? You think that equities are going to be volatile from now up until the elections? Do you think that could be the effect on the currency as well?
I think in the rupee, the big move is behind us. We moved from 44 to 60. That's a big move. And it is kind of covered for all the undervaluation of rupee. Now rupee is fairly valued. Of course, equity market flows or debt market flows will have some impact on rupee, but we are unlikely to see a big move in rupee. We'll see gradual depreciation in rupee because of the high inflation in India, but overall the big move in rupee is behind us. We are unlikely to see great depreciation or great appreciation. We should be moving around current level.